What's up, everyone? I'm just gonna make a quick video because I'm just getting a lot of questions about which flow do I take? How do I take this flow? What flow is good? What flow is bad? So I'm just gonna make a quick tutorial. So this might sound crazy to a lot of you, but it honestly takes kind of common sense for the most part, right? So if we're looking at flow, right? Now we want to just see like what makes it look good. So if we're just looking through this filter that I have, we're scrolling through flow, and we see this right here. So KNX 55 call for 117 expiration. Stock is at $50 right now. The bid and ask at $1.45, $1.55. It says spot price at 1.56. So it looks like they're paying a little bit above the ask. 2,263,000. 353,000 in premium, 2,500 volume, 377 open interest, and is showing 100% at the ask. So right then and there, you can tell that this is a pretty good flow, right? So we'll click on it. We'll click on the expiration, and we'll see that yes, it looks all at the ask. It was bought almost at the end of the market for around $1.56 for 390,000. It actually popped to $1.70, and now it's hovering at $1.65. So this right off the bat looks good, right? Good volume, good open interest, good, nice premium, and it's also 10% out the money, right? So the stock is at around 49.85. They're thinking that the stock is going to go to 55 by expiration, right? So this looks good. Okay. So this looks like a trade that I would take, right? But just because the premium looks good, the volume, the open interest, looks good at the ask, net premium skyrocketing, doesn't mean you should take it right away. You got to ask yourself, am I willing to risk $1.56? Right? I don't know your guys' portfolio size, right? You got to ask yourself, is this a contract that I can risk, right, for my portfolio? After you got that down, well, now you got to go to your chart, right? So you can see that, I hope this is recording on the, yeah. So what was that? KMX, right? KMX? NX. Okay. So here's the problem. So even if this flow looks good, right? The chart looks pretty nasty if you ask me. Okay. And it looks like since we have earnings coming up, that trade could possibly be an earnings trade. So if we're looking at the daily, I mean, you could think like, okay, well, it's been bouncing here, nasty candle on Friday, but it's held this pretty big support, right? It's been kind of actually struggling previously as a resistance here, below all moving averages, below the 200. So now you're like, oh, shoot. Okay. Well, the flow could look good, but the chart looks like ass, right? Earnings coming up. So you're kind of like, okay, this is probably an earnings trade. So that's how you kind of determine if you should take this flow trade, right? If we do another example that we can show that you got to be a little active with it. This NVIDIA call. So NVIDIA 131 call for 10.11. Stock was at 124.59, 0.65 to 0.66. Bought at 0.66, 40,000 in volume, 2.65 million in premium, tons of volume, tons of open interest, right? This expires next week. So right off the bat, you're like, holy shit, like this looks really good. Someone's betting 2.65 million for like a $6 out the money move, only 66 cents. Yeah, let's take it. Well, don't rush, right? Because we're going to click this. You can see that they bought it at 0.66, but either this whale found out something, someone told him or her, hey, we shouldn't buy this, or we should get out of this. They sold right away. They literally sold right. Look at this red bar right here, all at the bid, right? So they bought all of these at 0.66. They sold at 0.68. So I guess they made a tiny profit. Well, not tiny, but they still made a profit, but they are out of this trade, right? So you got to always, make sure you're kind of, keeping track of these. And then obviously I can help you guys if you need it. But you always got to make sure, keep updating the whale to see if they're now. Actually, this is honestly a pretty bad example. I didn't realize. See, this is why you don't rush into things. This is 44% multi-leg. So there is another leg to this trade. You know, it could be a debit spread, credit spread, butterfly, you name it. But let's just pretend that this is a single leg trade. You know, just a naked call. You see this and you're like, wow, it looks good, and then all of a sudden they get out. So that probably means that you should probably get out as well. And then let's do an ETF trade, because a lot of people, they'll see, you know, a cheap QQQ call or cheap SPY call, and they'll get in right away, right, for like a scalp, and you know, next thing you know, they get screwed, right? So if we do, I'm trying to find one with like a 0 DT expiration. Well, there's not many. Okay, well, anyway, let's do one that actually stands out. We can actually do this TLT. Okay, so this TLT 93 put for 1025 expiration. 90, it's at 95 right now, 0.28 to 0.3. They bought it at 3, almost 10,000 in size, 300K, 11,000 in volume, 5,000 open interest. So we'll click on this. Looks good, looks clean. Mostly all at the ask, a 3% out the money move. But again, this looks clean, but doesn't mean you should take it right away. So if you know, again, we got to go back to the charts, right? We got TLT. This is obviously a swing, right? So, you know, obviously a pretty big gap down, right? From Friday, the 200 EMA is at 95. So again, someone's betting that's going to go to around what, 93 this strike. That's basically kind of where it bounced off the 200 back in July, right? So this is basically their target. So again, you got to look at your charts. Does it make sense on your end, right? But it's, you know, for example, this is only a what, 30-cent bet. Well, okay. So you just got to ask yourself, all right, well, I'm willing, let's say I'm willing to risk 300. Okay, I'll buy 10 contracts. I'm willing to risk 300. I'll follow this whale and go from there. And again, if it doesn't work, it doesn't work. Big deal. Like, you just move on to the next trade. Not a big deal, right? And then one example I wanted to do was pretty, not an obvious trade, but it kind of makes you, you know, use your common sense and kind of, you want to know what's going on around the world as well, right? So Oxy was one. The cool thing about whales is that you can do a contract lookup. You can know exactly everything about that certain contract. So it was an Oxy 60 call for March. We took this trade. I want to show you why we took it. So if we go, yeah, okay. So this is a 7-day view. So as you can see, Oxy, so again, we all know what's going on. There's wars, you know, across the Middle East, this and that. So obviously oil is going to be a big topic. And it's been a, you know, it's been a pain in the ass to trade as well recently, right? But when you get a flow for 5.5 million at 3:30 to around 4 p.m., kind of like, okay, I got to take this. I got to take this regardless, right? And Oxy has been a lagger. Everyone's, everyone's talking about Buffett buying zone, this and that. And obviously the tensions in the Middle East. So then you have to kind of use your common sense. Like, okay, well, maybe it is time to go long on oil. And so when you see a trade Oxy and you see 5.5 million in premium, 21,000 that they ask, and it was only costing 2.3 per contract for 166 days out, it's a no-brainer for me, right? I know how much I'm willing to risk, and if I lose 1,000, this whale loses 5 million, right? So that's how I kind of took the trade. Again, not all trades like this will work. Just because there's a big premium doesn't mean that it's gonna be a successful trade, right? So you kind of just gotta, again, use your charts, use your common sense, risk management, know how much you're willing to risk. Go on the chart, right? Always look at your chart. Don't just look at the premium, right? and say, okay, I'm going to get in. Because then you're like, okay, well, when do I get out? Or is this whale still holding this and that? Look at your charts. The charts will tell you more about your position, right? So I think when was that trade placed? That trade was placed on 10-2. If you go back on 10-2, so obviously Oxy had a good day the day before, and then I don't know, okay day, but you see how the moving averages. Like so for me, I use a lot of moving averages. So that's my key indicator. And then we had a couple, like kind of like a resistance here. September 19th, Oxy broke right above it because you can see it did struggle here. It pushed back down. And once I started to see the moving average started to the upside, kind of broke above the resistance, and then you see that flow. You're like, okay, now that's check. Chart looks good. Flow looks good. I'm getting in, right? Know your risk. You can, if you're in this contract and you want to know where your stop could be, well, it could be right here, right? You got support right here, previous resistance. That's where you can have your stop. So yeah, that's basically it. You kind of like just, let's say for the notable flow, the flow that I post on X, don't just look at the premium, right? Because just because let's say a contract, has, 2 million premium, right? That doesn't mean anything. It could be 100 volume, right? Because it's an expensive premium. Gotta look at everything, right? How much out of the money is it, right? The premium, the volume, open interest. And the next day, you want to check the open interest, see if it carried over, so you see how on the second 24,000 volume, right, of Oxy, like, okay, well, let's see if they carried this over to the next day, right? Because if they carried over most of it, that means that they're very confident in this trade. So yeah, so 21,000 of them carried over. Okay, so you're kind of more confident, right? So this popped to 2.73, and now it's at 3.08 from Friday. So yeah, that's about it. Hopefully I explained a little bit on how to take the flow. It's a pretty quick video, and good luck. And maybe if you guys have any questions, either comment on the video or tag me on X. Yeah. All right. Thanks, guys.